Let's go to the real deal with inflation for next year, Dan. No? So the outlook is above 4% still for next year by the Bangko Sentral. But tell us, did these rate hikes of 2022 arrest the inflation expectations for next year? Did it arrest the second round effects, the spillover effects that could have happened by next year? And will we be seeing, a faster deceleration of prices? And when will that come, as early as the first quarter?
Yeah, that projection, 4.5% average next year, actually means that there is going to still be some elevated inflation in the first half. So, we could expect some downward trend, probably, starting around end of March. And this is mostly because of the base effects. So the base effects will actually be helping us in terms of the headline reading. So what that also means is that there's going to be some trajectory moving towards the 2 to 4% target of the BSP, probably hitting it by middle of next year. So that's around June or July. We did see, actually that was the most important development out of the BSP meeting yesterday. So if you combine that with Governor Medalli's hawkish tone, that also suggests that the door remains open for more rate increases early next year. So our base case actually is that headline inflation will return to the BSP target of 2 to 4% by the middle of 2023. So that will afford the BSP some pauses already. So they could, if the Fed actually pauses, that also means that there's scope for the BSP to pause as well.
Okay. Now, sir, we're at the end of the year. Looking back, have we addressed the supply side issues? In terms of the food crisis, probably the wage hike issues, the transport crisis, the energy prices. Have we in any way, especially with BBM's admin, have they delivered such that next year we will be feeling less pain?
In terms of inflation, overall inflation, the main driver is food. So if we drill down on the data, we're seeing several food commodity items that are spiking. So that's driving overall inflation. So that's the food basket is around 32% of inflation. Now, if we juxtapose that with imports out of, if we juxtapose that with food imports, we will see that the items that have been driving inflation up, in terms of the importation, some have actually declined year on year to double digits. So we're not really importing compared with previous years. So what that means is food inflation can be solved partly with higher importations as well. But that's easier said than done, given FX has declined. So that will mean that it's more costly for importers. But that probably could be a solution as well. So if you do expect, if you anticipate more imports coming into next year, that will ease the price burden in terms of the food basket. The other story there is food inflation could be transitory. It's the holiday season now. So seasonally, there's very high consumption. So retailers, sellers actually take advantage of the demand. So prices tend to be higher in the holiday season. So in the past, before the pandemic, prices tend to go down after the holiday. So in January, we'll have to watch out for that, especially the core side.
Right.
Okay.
Core inflation, the main driver, we have plus of 10% weighted in the CPI. It's going up partly because of demand, but partly because of food prices as well. So it's bleeding to the core already. That's why it's more important.